So your friend just pulled up in a brand new car, a clean, shiny, that new car smell you can practically see through the windshield. And you're standing there with your old beater, or worse, taking the bus. You don't have a car. You definitely don't have $40,000 sitting in your bank account. But everyone around you seems to be upgrading their lives. New cars, bigger apartments, the latest tech, and, well, you don't want to feel left behind. So you walk into that bank or open that loan application, and they say yes. The monthly payment? Only $748 a month. That's the average for a new car right now in 2025, by the way. And to you, that sounds manageable. I mean, it's just $750, right? So you sign, and right there in that moment, the credit trap snaps shut. What I'm about to show you is something most people never realize until it's too late. And honestly, I didn't get it either for the longest time. I'm not anti-credit or going to tell you to never borrow money. This is about understanding what credit actually does to your life and why the system is designed to keep you locked in. 1. Credit is normalized, so no one questions it. We live in a world where going into debt is not just accepted, it's celebrated. Like when someone tells you they bought a house, what's the first thing people say? Congratulations. Nobody asks, wait, did you pay cash or did you just sign up for 30 years of payments? A house, a car, a phone on monthly installments, a couch on 0% financing, all at the same time. And this is considered normal. In fact, if you don't have debt, people look at you weird. The average American right now carries over $104,000 in total debt. Credit cards, auto loans, mortgages, student loans, it all adds up. And we've been conditioned to see this as just how life works. But what nobody tells you is this: the moment you take on credit, you're making a trade. You're trading future freedom for present comfort. And that trade has real consequences. See, when you have debt, your income is no longer really yours. Before you can do anything with your paycheck, invest it, save it, spend it on what you actually want, you have to pay your creditors first. Your car payment, your mortgage, your credit card minimums. That money is already spoken for before it even hits your account. And the more credit you take on, the more of your income is locked up in these obligations. It's like running on a treadmill that speeds up every time you add another payment. 2. Credit turns income into a prison. And doing so, credit is no longer enjoyable. It's a prison. Let me guess, you're at a job you hate. Your boss is micromanaging you. The work is soul-crushing, and you wake up every Monday wanting to quit. But you can't. Why? Because you've got a $748 car payment, a $2,200 mortgage, maybe $500 in credit card minimums, your phone bill, your insurance. All of it adds up to over $1,200 a month on average just in debt payments for most Americans. So even though you're miserable, even though you know this job is killing you slowly, you stay. Because if you leave, how are you going to make those payments? This is what I mean when I say debt turns income into a prison. Your job stops being a choice. It becomes a necessity for survival. You can't take risks. You can't slow down. You can't pivot careers or start that business you've been dreaming about. You're trapped. Most people who are stuck like this aren't lazy. They're not irresponsible. They're hardworking people who made what seemed like reasonable decisions at the time. They just didn't understand the cage they were building around themselves because society tells us, take the loan, it's fine, everyone does it. That's how you get ahead, but that's not how you get ahead. That's how you get stuck. 3. The family advice trap. Let me ask you something. How many of us just copied what our parents told us about money? Buy a house as soon as you can. You need a reliable car, just finance it. Debt is normal, everyone has it. And look, I'm not blaming our parents. They were giving us the best advice they had based on their experience. But the problem is, their experience was in a completely different economy. When our parents were buying houses in the 80s and 90s, you could get a decent home for 2 to 3 times your annual income. Today, the average home costs 5 to 6 times the average income. In some cities, it's 10 times. When they bought cars, prices were lower and wages went further. Now we're financing vehicles that cost more than some people's annual salary. The world changed, but the advice didn't. And copying all this in this new system is dangerous, especially when nobody taught us real financial education in school. 4. Credit is easy. Because it's profitable. Because if they did, you'll learn that banks don't give you loans because they want to help you. They give you loans because it's incredibly profitable for them. When you take out a car loan at 7% interest, the bank has you locked in for 5 to 6 years paying them that interest. If you borrow $42,000, which is the average new car loan amount right now, at 7% for 69 months, yes, that's the average term, you'll pay about $7,000 just in interest. That's $7,000 you're giving to the bank for what exactly? The privilege of driving a car that's depreciating the moment you drive it off the lot? And credit cards? Oh, don't even get me started. The average credit card APR is over 22% right now. If you've got the average balance of $6,730 and you're making minimum payments, it'll take you 22 years to pay it off. And you'll pay $18,000 in interest on that $6,730 balance. Let me say that again. You'll pay nearly 3 times the original amount just in interest. The system is designed so the bank wins even if you struggle. Actually, especially when you struggle. Because if you can only make minimum payments, you're the most profitable customer they have. And they won't suggest the strategy that's best for you. Of course not. They suggest the strategy that's most profitable for them. 5. The snowball effect of debt. It creates this thing where one credit doesn't just stay one credit. It starts innocently enough. You buy a house, okay, that's normal. But now your mortgage is eating up $2,000 plus of your monthly income. So when you need a car, you can't really save for it because all your cash flow is going to the house, so you finance the car too. Now you've got the mortgage and the car payment. And then life happens. Your laptop dies, your dog needs surgery, your AC breaks in the middle of summer, and you can't afford it because all your money is tied up in those fixed payments, so you put it on a credit card. But next month something else happens, and the balance grows. And suddenly you're juggling multiple debts, and each one felt manageable on its own, but together they're suffocating you. This looks like a snowball effect of debt. And right now, 60% of Americans with credit cards are carrying a balance month to month. That's over 100 million people trapped in this cycle. 6. Credit feels good. Now, costs you later. You know what the most insidious part of credit is? It feels good. When you finance that car, you get to drive it home today. You don't have to wait. You don't have to save for 3 years feeling like you're missing out while everyone else is cruising around. When you swipe that credit card, you get the dopamine hit now. The new outfit, the nice dinner, the concert tickets. You get to live the life you want right now instead of waiting. Credit gives us instant gratification. And in a world of Instagram and TikTok where everyone seems to be living their best life, waiting feels like losing. But of course, nobody shows how you're not just paying for that comfort with money. You're paying for it with time. Years of your life that you'll spend working to pay off what you bought today. You're literally borrowing time from your future self. And future you? They don't get a vote. And this is the trap. Because once you've made that decision, once you've signed that loan agreement, there's no undo button. You're committed for years. 7. Social pressure makes it worse. You see your friends buying houses, getting new cars, taking expensive vacations. And even if logically you know they might be drowning in debt, emotionally it still affects you. You start thinking, am I falling behind? So you make decisions based on keeping up, not based on what actually makes financial sense. You finance the car because you don't want to be the one without a car. You upgrade your apartment because you're embarrassed to have people over. You buy things on credit because everyone else seems to be doing fine, so why can't you? And boom, you're trapped in the same cycle as everyone else. The irony? Those people you're trying to keep up with, they're probably doing the exact same thing, trying to keep up with someone else. We're all in this rat race together, all pretending we're doing better than we are, all going further into debt to maintain the illusion. It's madness. 8. Living in what you own versus living in what pays you. All right, here's where I'm probably going to lose some of you, but stay with me because this is important. Taking credit to live in a house that doesn't generate income is tying up your most valuable resource, capital. Let's say you've saved $50,000. You could use that as a down payment on a $300,000 house. And everyone's telling you that's the smart move, right? But here's the other option. Keep that $50,000 liquid. Rent where you live. Yeah, I said it. And use that capital to invest in assets that actually generate income. Could be index funds, could be a business, could be real estate that you rent out to other people. The house you live in costs you money every month. Mortgage, insurance, property taxes, maintenance, HOA fees. It's all going out. And yes, you're building equity, but you're also locked in place. You can't easily move for a better job opportunity. You can't pivot if your financial situation changes. Your capital is stuck in the walls of that house. But if you rent where you live and invest what you save, that money is working for you. It's creating more money. It's giving you options. Now, I know what some of you are thinking, but rent is throwing money away. Is it though? Or is it the cost of flexibility? The cost of keeping your options open? The cost of not being chained to a mortgage for 30 years? Look, I'm not saying never buy a house. I'm saying be strategic about it. Buy a house when it makes financial sense for your situation, not because society says you should. And if you do take on debt, make sure it's debt that improves your financial position, not debt that just locks you into more payments. 9. Not all credit is evil, but most is misused. The first thing you need to know is make sure you know the difference between good debt and bad debt. Bad debt, for example, is debt that buys you lifestyle, status, or comfort. The fancy car, the bigger house than you need, the designer clothes on credit. This debt makes you feel rich while making you actually poorer. Good debt is debt that produces income, pays itself back, and improves your financial position. A loan to buy a rental property that cash flows. A business loan that generates more revenue than it costs. The question you need to ask before taking on any debt is, will this make me more money or will this just cost me more money? If the answer is, it'll just cost me money, then you need to seriously reconsider, because that's the debt that traps you. 10. The real cost of credit is opportunity. You know what the biggest cost of debt is? It's not even the interest, it's opportunity. Every dollar going to debt payments is a dollar that can't go toward building wealth. And in today's economy, optionality is everything. The ability to pivot, to take risks, to jump on opportunities, that's real wealth. Not the car you drive or the house you live in. But debt kills optionality. It puts you on rails. You must keep working. You must keep making those payments. You can't do anything too risky. And meanwhile, the world is changing faster than ever. New opportunities are popping up left and right, but you can't take advantage of any of it because you're too busy making your monthly payments. 11. The way out of the credit trap. So, what's the solution? Well, it's simple, but it's not easy. Delay gratification. Save first. Use credit only when it increases income. Rent where you live if that gives you more flexibility. Invest where it pays you back. Buy the used car in cash instead of financing the new one. Keep your phone for an extra year. Say no to lifestyle creep. And most importantly, question what everyone else blindly accepts. Just because everyone has debt doesn't mean debt is good. Just because everyone's buying houses doesn't mean you should. Just because everyone's financing their lifestyle doesn't mean that's the path to wealth. The uncomfortable truth is that building real wealth requires sacrifice in the short term. It requires you to look behind for a few years while everyone else seems to be getting ahead. It's the tortoise and the hare. Except in this version, the hare is in debt and can never stop running. I'll leave you with this in your head. The most valuable thing you have in your hands is freedom. Don't let it become expensive by letting debt control your life. All right, that's it for this one. If this video changed the way you think about credit, make sure to hit like. And if you want more videos breaking down financial traps nobody really talks about, let me know. Actually, drop a comment and tell me what I should cover next. Student loans, mortgages, the real cost of lifestyle inflation? Drop your ideas here below. Thanks for watching, and I'll see you in the next video.